Can you show examples of bond premium amortization? Have you ever wondered how companies handle the extra money they receive when selling bonds for more than their face value? This extra amount is known as a bond premium, and it needs to be recorded properly over the life of the bond. Let's break down some examples of bond premium amortization to clarify this process. First, consider a company that issues a bond with a face value of $100,000. The stated interest rate is 9%, but the bond sells for $100,100. This creates a bond premium of $4,100. If this bond matures in 5 years, the company will use the straight-line method to amortize the premium. This means they will divide the premium by the number of years. So, $4,100 divided by 5 years equals $120 per year. Each year, the company will reduce the bond premium account by $120. This also means they will decrease the bond interest expense by the same amount. If the company pays interest semi-annually, they would amortize for $110 every 6 months. The journal entry for each interest payment would involve debiting bond interest expense for the coupon payment minus the premium amortization and crediting cash for the coupon amount. Now, let's look at another example using the effective interest method, also known as the constant yield method. Imagine an investor buys a bond with a face value of $1,000 for $1,050, resulting in a premium of $50. This bond pays a 5% coupon semi-annually, which means the investor receives $25 every 6 months. To calculate the premium amortization for the first period, we need to find the bond's yield to maturity. If the yield to maturity is 3.89%, the semi-annual yield would be 1.9 for 5%. The premium amortization for the first period would be calculated as follows: purchase price multiplied by semi-annual yield minus the coupon payment. So, $1,050 multiplied by 1.9 for 5% minus $25 equals negative $4.50. This means that $4.50 of the premium is amortized in the first period, reducing the bond's carrying value and interest expense. When a bond is issued at a premium, the company will credit bonds payable for the face value and credit bond premium for the excess amount received. Over the life of the bond, the premium is amortized, which reduces interest expense and the premium account. For instance, if the premium amortization for a period is $820, the entry would debit bond premium and credit interest expense by $820. The cash interest payment is recorded separately based on the bond's stated coupon rate. From a tax perspective, amortizing the bond premium reduces the taxable interest income reported by the bondholder throughout the bond's life. The Internal Revenue Service requires using the constant yield method for bonds issued after 1985, which aligns with the effective interest method in accounting. In summary, bond premium amortization can be done using either the straight-line method for simplicity or the effective interest method for accuracy. Both methods gradually reduce the bond premium over time, adjusting interest expense and the bond's carrying value in financial records. Understanding these examples can help you navigate the world of bond premium recording effectively.